Good evening, students. Today I will discuss a topic capital assets pricing model of security analysis subject. But before discussing this topic, I would like to share some outcomes and learning objectives from this topic. So you can see it on this screen. I have mentioned some learning objective and outcome. Learning objective, in my opinion, like that to provide the conceptual framework of CAPM model, and outcomes will be the student will be able to calculate expected return from the security, and second outcome will be the student can decide that stock is overperformer or underperformer. Means after discussing this topic, you will be able to calculate expected return from security, and also you will be able to decide is a particular stock is over performer or underperformer. So let's start the discussion. CAPM model. Actually, this model provide a relationship between relationship between risk and expected return for a particular stock. There are two tools used for this model. First is capital market line. Actually, this tool is used for expecting the return from the portfolio. Portfolio means basket. Portfolio means basket of assets in which investors made their investment. And second tool is security market line. This tool is used for expected return from a particular security. So today I will discuss only one tool, that is security market line. This tool, the security market line, actually it is a graphical presentation. It is which show the relationship between the systematic risk and expected return. This concept is given by the William F. Sharpe, and formula is as below. It is actually security market line is totally based on this formula. Formula is like expected return is RF plus beta multiplied by RM minus RF, where if here so the expected return of investment, RF is the risk-free rate, B is the beta of the investment, RM minus RF is the risk premium. In this PPT, I would like to share a story for the logical explanation of this formula with two characters. In the next slide, you can see there are two characters, Dr. Dilip and Dr. Manish. Both are working together at Phi University. But one day they are discussing about investment issue. Dr. Dilip said to Dr. Manish like that, I want to deposit some money in bank for long term. Then Dr. Manish reply and ask to Dr. Dilip, why do you not invest in stock market? Then Dr. Dilip assured him, I get a return of 6% without any risk from FD in bank. Then Dr. Manish replied to Dr. Dilip, but you can increase your return with a little risk. In this slide, you have to note one thing, that is risk-free rate. Here, risk-free rate is 6%. How we can say 6% is risk-free? Because FD offer a fixed rate of return. There is no chance to fluctuating in expected return. So we can say this 6% is risk free. Okay. In next slide, Dr. Dilip asks to Dr. Manish, how much can I expect if invest in the market? Then Dr. Manish replied, it is much as your expectation from bank, including the extra return for risk. It means, as per Dr. Manish, what he is saying, there are two component of expected return. First component is expectation from bank, plus second component is extra return of the risk. You can see in note 2, as per the statement of Manish, Dr. Manish, expected return would be equal to the risk-free rate plus risk premium. Here, risk premium means difference between the return from market and risk free. So in note 3, you can see, as per the statement of Dr. Manish, first component expected from bank, that is risk-free rate, which is discussed in earlier slide. And second component is extra return from risk, that is a risk premium may be calculated as RM minus RF. Then Dr. Dilip asked to Dr. Manish where to invest. Then Dr. Manish reply him, you can invest in share of Reliance company. But here Dr. Dilip is little bit confused and asked to Dr. Manish like, but you were saying that invest in a stock market, but now you are saying invest in Reliance share. Then Dr. Manish tried to convey Dr. Dilip and giving the statement, yes, investing in stock market is done only by investing in company shares. Then Dr. Dilip is satisfied and asked to Dr. Manish, okay, I will tell you after 1 week. That's fine. Dr. Manish said, okay, fine. After winning 1 week, both are met, and Dr. Manish asked to Dr. Dilip about their investment decision. Dr. Manish asked, what do you think about investment in Reliance? Then Dr. Dilip observed and studied some data related to market and Reliance industry and shared his experience to Dr. Manish. He told, I have observed some points. If the Sensex has risen 5% in Reliance price has increased by 10% in the same period. If the Sensex has fallen by 5%, the Reliance shares has dropped by 10%. Then Dr. Manish said, of course, it can happen. In this slide, I would like to focus on one more note, that is note 4. In note 4 you can see as per observation of Dr. Dilip, the Reliance share is more risky than market. Okay, it can be measured through the beta. Normally we can use beta for beta to measure the systematic risk. It is a measure the volatility of a particular share in relation to the market. In this example we can see the you can measure beta through the data observed by Dr. Dilip. He observed 10% Reliance return and 5% market return. Then beta equal to 10 divided by 2. It means 2 represents Reliance share is double risky than market. In note 5, systematic risk can be reduced. Systematic risk cannot be reduced, not diversifiable, and unsystematic risk can be reduced. Standard formula of beta is can be calculated through beta equal to covariance between return of stock and return of market divided by variance of return of market. Okay, in our next slide, Dr. Mani is assured to Dr. Dilip, if you feel that you are taking double risk, then you can also double the premium. Then your expectation will be equal to the risk free plus double risk premium. As per Dr. Manish, if any assets is double risky they compared to market, you can expect more premium or double premium. So as per Manish, Dr. Manish's statement, expected return would be, you can see in note 6, risk-free rate plus beta multiplied by risk premium. In equation form, expected return equal to RF plus beta multiplied by RM minus RF. Then Dr. Dilip asked one question, what will be if risk is half? Dr. Manish replied, then the risk premium will also be half. And then Dr. Dilip is fully satisfied with the argument with the Dr. Manish. Let's see one example for understanding all the things which are shared through a story. Uh, they, one example is mentioned in video. Let's calculate the expected return on a stock. There are some information related to risk-free rate, that is 6%. Market return, Sensex return is 10%. You have to calculate your various. You have to calculate stock expected return at the